My name's John Jagerson. We're going to be talking about selling options in the forex, and this is something. So I had a really interesting discussion here recently with a friend of mine who's an asset manager, and fairly successful. And he was asking why it is that forex traders seem to be kind of preoccupied with only the spot market. And when there are ways to be able to kind of diversify their investing strategies as well as what they're investing in. And this is one of those great ways to be able to do that. And yet I don't see a lot of forex traders taking advantage of the opportunities. And I think that's probably true for a couple of reasons. Number one, trading options is there's a certain level of complexity. So there is a learning curve that has to be overcome. So which is why attending presentations like this can be a lot of fun to see something new, get a couple of new ideas. And second, some of these are reasonably new products as far as their availability to forex traders. So not everybody has been able to trade these as readily as you can today over the last few years. In fact, the exchange traded forex options, which is primarily what I'm going to be talking about today, and I will talk about what the difference is between exchange traded forex options, just vanilla options, it's something you think about when you think about calls and puts, versus OTC, over the counter options, that there are a couple of dealers who are beginning to offer those products in their across their dealing platform and working with your dealer. Which, by the way, I've been really impressed with the quality of some of those offerings, and the improvement in the quality of some of those offerings from where they've been over the last 3 years ago. The OTC options market was it was embarrassing to say the least. I can't imagine who was buying or selling options in the OTC market 3 years ago, but it's gotten a lot better now, and in many ways is the equivalent to the exchange traded versions. So let's get into a bit of an introduction here. The options that I'm going to be talking about are listed on U.S. exchanges. They're available to international investors. You do need an option broker to be able to take advantage of exchange-traded forex options. There's some great ones. Obviously, they handle both U.S. domestic accounts as well as international accounts without too much trouble there. And obviously, one thing I forgot to mention is along with who I am, you're welcome to send me an email if you'd like. My specific thoughts on brokers that I think do a good job or whatever it is. I'll give you a few recommendations for you to check out on your own, and I'll give you a couple of tips today. So because I've already got a question about that right now, and so send me an email about that, and let me if you don't mind. It's john@pfxglobal.com. But I will be talking about a couple of ideas today that might be able to give you a start to in evaluating a couple of brokers, because just like in the forex market, a lot of the decision-making process is a bit of a personal trading preference, because the products and the costs and the trading costs are largely equivalent across the board. There's not a ton of difference, so it comes down to whose platform do you like better and things like that. So the question, but I wanted to handle this question as it's popping up here. CVJ, you're asking, how do I feel about the new Philly exchange developing in its first year? I assume you're talking about the forex options that are newly listed on the Philadelphia exchange. They're also new on the ICE, by the way. And so for those of you who are interested in learning a little bit more about these types of options from the exchanges themselves, where they're actually traded and listed, I've got two URLs up here, www.ice.com and www.phlx.com. The Philadelphia exchange, it has an options exchange, and there are some forex options that were listed in both places early last year. I've been really impressed. Now, forex options have a big advantage because, unlike stock options, for example, where there really aren't very many stock options out there that have great underlying liquidity. Meaning, there are a lot of stocks out there, and of all the stocks available out there that have options available on them, just because stocks aren't, they just aren't traded as much as the forex is. That underlying liquidity creates a wide spread, and sometimes can create a squeeze in the options where you have some liquidity problems. But in forex options, because the underlying, the forex itself, is so liquid, you don't have a lot of those disadvantages. So it's really a beautiful application for options because volume almost doesn't matter at all because the underlying is so liquid. So let's talk about what I'm going to be discussing specifically today. And what I want to do is to actually show you that there's really only a couple of things you can do with this particular strategy, but there's a lot of ways you can adjust it based on your risk tolerance and where you think, based on your technicals and fundamental analysis, that the currency pair is going to go, or more importantly, when you're selling an option, you're even more concerned about where a currency is not going to go. And I'll show you what I mean as we look at some of these specifics. But let's talk about what exactly selling an option means. There are two kinds of options, and I'm not going to get I don't want to get wound up in a lot of the minute details around options pricing and the mechanics of options, because we're going to do some practical examples today that I think, and I'd plan to do, I'd like to do a few examples so we can kind of repeat the process a few times, and it'll make a little bit more sense. But let me talk about the two options we are going to be discussing. The first is a call option. The second is a put option, as you can see here. When you are selling a call option, it essentially gives you the obligation to sell a currency at a set price. We're going to be talking about what that set price is and what that means. Now, and when I say obligation, so what you're really doing, you're doing something very similar in nature to what you do when you're just selling a forex pair. When you sell a forex pair, if you don't put a stop on it or anything like that, your liability is technically unlimited. Well, the same thing is true with selling a call option, but there is a significant difference and a huge advantage with selling a call option when you're bearish on a particular pair versus selling the pair itself. I'm going to talk about that in a minute, but two of those benefits are, number one, you get paid your profits, or your potential profits, I should say, up front. Now, and at that point, it's your responsibility to try to hang on to them as the trade progresses. Number two, the market doesn't have to move anywhere for you to remain profitable. So it doesn't have to actually fall. It just doesn't. You just don't want it to rise. And we'll talk about that here specifically in a minute. So selling a put option. And by the way, for those of you who are somewhat familiar with options, sometimes when we talk about shorting options or selling options, it's a little confusing because I find that there's a lot more traders out there who are buying options than selling them. It's just like any financial market. It's kind of selling an option. It's somewhat more sophisticated than buying them. And so a lot of people will start as long options traders and then progress to become short options traders, which is what we're talking about today. And it can be a little confusing because everything flip-flops on you. So selling a call is a bearish thing to do. Selling a put is a bullish thing to do, and we'll talk about exactly why that is. But that's kind of contrary to a lot of long options traders. So selling a put, it gives you the obligation to buy the currency at a set price. Now, one thing that I need to say here is that I'm kind of using the classic definitions of selling a call and selling a put here by saying that it gives you the obligation to sell a currency or it gives you the obligation to buy a currency. That's not actually true. What we're referring to when I say obligation is if that option contract were quote unquote exercised. And in the futures and options market, you have a if you're short, you have it's incumbent upon you to live up to your obligation by delivering whatever it is that the option was given on. So if you sold a call on a stock, for example, then you're responsible for coughing up that stock if you get quote unquote called out. With forex options, they're cash settled, which means that just if you wind up in a net positive or a net negative position, it's really your net loss or net gain that's taken care of. You don't ever you don't actually get anything put to you or delivered to you, nor are you required to actually deliver anything except to make good on those losses or to collect the profits. So cash settlement makes things really convenient. Okay, so number four, they are available on the majors. I probably should have differentiated here because I think this might be confusing. Forex options are available on the majors that are exchange traded, so these two exchanges, and you can deal with a forex broker on that. And there are options that are available on the crosses. When I say crosses, I mean things like the pound yen or the euro cat or whatever. They are available on the crosses in the over-the-counter market. So there are a couple of good dealers who are offering those, and I'm seeing more and more dealers planning to release those products here in the very near term. So you got the majors on the exchanges, and you get crosses and majors in the OTC market. So it's kind of a, what do you prefer as a trader? The underlying value, so I'm going to be talking about the exchange traded versions here. The underlying value of an option contract is essentially the equivalent of a mini contract. So, for example, in the case of the dollar yen, the underlying option contract, one option contract is the equivalent of one mini contract in the forex. So one $10,000 lot of the euro dollar. I'm sorry, of the dollar yen. And the spread can be anywhere from 5 to 10 pips. So it's now that seems a little wide, but I'll show you some ways that we deal with that and how that plays out in real life. And I think that the spread will continue to narrow here in the near term. So it's something, as the market matures a little bit, it'll continue to come down. Okay, so options are flexible. Options give you options. That's really the bottom line, which is great because when you're just looking at a currency pair, there are oftentimes, in fact, actually, one of my first examples I'm going to be talking about today is the dollar yen, and the dollar yen right now. I gotta tell you, I'm a little torn. Overall, I'm bullish probably in the long term, but in the short term, we got all kinds of pressure from China right now. I mean, we've got insane efforts to tighten monetary policy over there going on this week. That's killing stocks in China. It's increasing reserve requirements, etc. So that's gonna put pressure on the yen. Well, at the same time, we got Bernanke scheduled today to come up and probably say very soothing things in his statements that has a high likelihood of offsetting investors' concerns about risk, which could have a lifting effect on the dollar yen. So I'm in the situation where I'm thinking, gosh, I got all this pressure on the yen to the downside, but I really don't know that it's going to drop very much. And yet I've got a lot of reason to believe that, even in the short term, it might pop up a little bit, but with all this other pressure, it's probably not going to move up very much at all there either. So it's going to be a rocky ride. Well, options give me the ability to kind of adjust my trade based on not just where I think the market is going to go, but what that ride is going to be like, how rocky it's going to be. And so my first example is going to be on the dollar yen because that's something that I'm trying to evaluate today to take action on. So number two is options do have an expiration date. So like a futures contract, they have an expiration date. Options, by the way, they expire every month, essentially, so on the third Friday of the month. Now, OTC options are really flexible, where you can virtually pick any expiration date. Just about any day in the future that's more than a week out in the future, you can pick as your expiration date. But exchange-traded options, they expire on the third Friday of the month. In fact, expiration for January is tomorrow. So January's options that have been trading on the exchange for months now will all be settled, sold, or just expired, worthless by tomorrow afternoon. And so today we're going to be actually looking forward about 1 month in the future to February expiration, which I believe is around the 15th, the third Friday in February. Now, one thing that I want to kind of keep straight is that although you can choose your expiration date, I mean, we could go out more than a month, certainly, but I don't usually, by the way. I tend to keep my options 20 to 40 days before expiration. So if I'm trading options, I try to keep them in that range. However, lots of times people look at they'll listen to me talk about trading options, and they'll think that expiration means that you can't get out early. Well, it's just like a forex position. I mean, even spot forex contracts expire in 3 days. They just do an automatic rollover. So expiration really has nothing to do with when you get in or get out of the trade. You can get in or get out whenever you want, and typically you are definitely getting out of a short position before expiration. And there's a reason for that. Even if you're in a really profitable position and the option is nearly worthless, which is actually good for you as the seller, it's quite likely that you'll just leave. That you will get out of the option early before expiration, and you certainly can do that. So how do you profit? How do you make money doing this? What exactly happens? Well, it's essentially as I mentioned before, a call and a put. When you sell those options, you are entering into an obligation. So you're taking on a responsibility to do something. And one way you could look at it is that the option buyer is essentially paying you a premium that you get to keep no matter what, to take on some of that option buyer's risk. So they're taking the other side of the position from you. Now, as the seller, you're kind of taking on the role of the market maker in a way, because you're providing some liquidity into the market. You're providing this liquidity to the option buyer. And in order to do that, they're going to pay you a premium. That's where your profit comes from. In the case of a short call, what you're really doing is that you're taking on a responsibility to sell a currency in the future, and you're going to get paid a premium up front, and you are speculating that the currency pair will decline if you are short a call, if you're selling calls. Likewise, if you short a put, you're obligating yourself to fulfill a responsibility, which in this case is that you're willing to buy a currency pair at a specific price at some point in the future. And now selling a put is bullish. So you really want that currency pair to rise, because that's going to put you in a more profitable position. And there are a lot of things that are on your side to make this to increase the odds of your of having a successful conclusion to your trade. Okay, Rappy, I wonder if you might be able to clarify your question a little. I'm getting a question here in the chat box that says, "Hi John, where can I check these days? You said that tomorrow is expiration date. Let me take a stab at your question if I'm not answering it correctly, and I'm going to go into actually a fair amount of detail on what I think you're asking. But if I'm not if I'm not answering it, please clarify it for me, okay? So I said that tomorrow is expiration date, and you're probably wondering, well, how do I know, or how can you tell what expiration date is? Just a reminder, it basically happens it's the third Friday of every month. So when you're actually finding the option you want to trade, they're priced by months. So you can see we'll be going to look at February's options today, and we know exactly when those February options will expire. So we'll see what their prices are, what their expiration date is, what their strike price is. We'll know all of those things today, so we can plan for that in the future. Okay, so I'm gonna stop sharing my screen. I'm gonna go to my charts. Okay, I have the dollar yen up here today. We're already getting a move to the downside. Let me know if you can't see this for any reason. So very interesting movement today. Just as a little side note, is kind of interesting actually. To my point about the about the dollar yen, there are reasons why I think it should be going up. One of which, of course, is that the equity futures are up already. I mean, we've had they've been coming down a little bit, but this morning before the open, but equity futures are up pretty good. We've got the NASDAQ futures were up about 14 points a few minutes ago. The S&P futures were up about 5.5 points a few minutes ago. So I haven't looked at them for a little bit, but the dollar yen was actually down. So what's going on? Well, it's got all kinds of pressure, and there's risk issues that they're dealing with. And we're looking at the yen here, and I'm thinking, well, well, maybe I have a long-term bullish outlook on the yen, but I really have no idea where it's going to go in the next 30 days. It's going to get pushed around easily by so many other things. I really just don't know. So one of the things that I can do is, rather than trying to evaluate, okay, so the S&P futures are down, are down at this point. Okay, well, not a big shock seeing how big the dollar yen's moved down. So that's happened in the last half hour. Well, it's moving pretty fast. I wonder if we're gonna have. I bet we're gonna have a pretty volatile day. Actually, I would wager we're gonna get a lot of volatility all the way through Bernanke's statement. So, I'm reluctant to count the dollar yen down for the day until we see those statements come out. But we'll see. However, again, this is kind of all to my point. We've got this, pretty wild volatility, and the question is, do I want to short the yen? Because I could get whipped pretty easy. In fact, the other day I wrote a blog article that I was saying, look, I think the potential for a whipsaw is really high, which is exactly what we got yesterday. Subsequent to that, and so do I want to take a short position? Not really. But what I might want to do is to establish a reasonable resistance level, and then try to find an option contract that would allow me to profit on the market's movement, as long as it stays below or a certain level, so or above. But in this case, since we got so much wild movement lately from risk and pressure from Chinese economy and such, I'm kind of biased in the short term to the downside, I suppose, even though I'm biased to the upside in the long term. So I got the dollar yen. I'm thinking, all right, I'm going to put a resistance line up here at about 110. I think that there is pretty high likelihood that we're going to stay underneath 110 for the next little while, whether it's a week or two, or even for the next 4 weeks or so. And this kind of cuts through. It's almost the equivalent of the bottom of these two shoulders here on this inverted head and shoulders pattern, shoulder, head, shoulder there. So this is a pretty reasonable resistance line here at 110. So keep that in mind. Now here's what we're going to do. I'm going to shift gears a little bit, and we're going to look at. I'm going to go to the SIBO, and I'm going to give you a couple of URLs to check out. Let me share this with you. Okay, so you should see my web browser. And where I am, by the way, and I've shown this before, so a lot of you who've been in my audience as I've talked about trading options have seen this same resource before, but for those of you who haven't, you might want to jot down a URL. It's cboe.com. And the CBOE is a big options exchange in the US. In fact, it's the biggest. And they have a couple of resources there for traders who, maybe you don't want to give your information to a forex broker yet, or an options broker yet, or whatever, and you want to do a little paper trading, which I highly recommend. Well, it's a great resource because right across the top here you see all these tabs, and one of which says Trading Tools. Under Trading Tools, you'll see two paper trading platforms. One is called Virtual Trader, and the other one is called Paper Money. I like Paper Money, and so that's the one I'm going to be using in the demonstration today. Which that's what you're seeing here right now. Is I brought up the Paper Money trading station. I'm going to put in the symbol for one of these options, and we're going to start talking about the dollar yen's options and how we might be able to take advantage of the fact that I'm speculating that we're not going to go above 110 in the near future. On your own, definitely check this website out. Tons of resources out there. It's an exchange, so they're reasonably impartial, and lots of free resources there. And it's a great way to, before you can really legitimately trade any strategy, and anytime you're trying to learn anything about trading, I'm a big believer. It doesn't matter whether you like the strategy or not. If you want to learn how it works, paper trade it so that you get some ideas. Okay, so let me give you another tip, by the way. Options are kind of like stocks. They have symbols, and in this case we're going to be looking at the dollar yen's options or option contracts, and the symbol is YUK. Those two URLs that I gave you before for the for the ICE, the www.ise.com and the Philadelphia Exchange, you can find the option symbols on those websites. They have a whole section dedicated to forex options and information about them, including their symbols. Okay, so this is a paper trading platform, so I'm going to be entering a couple of trades. It's not recommendations, obviously, and the market is closed right now anyway, so they'll just be kind of sitting to be executed, and this is a paper trade platform anyway. All right, so YUK, and there's my spot price, 106.78. Now you'll notice this is stuck at yesterday's close price because the options market isn't open yet, so this is lagging the spot price. So just ignore that right now. Let's assume that the options market doesn't open for another 2 hours. So we're a little bit ahead of the market right now. Which it opens, by the way, at 9:30. Well, essentially it starts trading at 9:30 Eastern Standard Time in the U.S. So what I've done is I've gone down below the, we've got a quote bar here, so it's spot price, and I'm down in the chain sheet. And you'll notice here it's divided basically by month. So I've got March, June, September, December, February, even January. And right next to that in parentheses, you'll see it's even telling me how many days do I have until expiration. Well, I have 1 day till expiration for January, so we're just going to ignore those. Those aren't worth anything to us. In February, I've got 29 days until February's expiration, and every day this changes. So it's really, really handy, actually. And now you'll notice that I kind of have the same information on both sides of this column that's subdivided by this column in the middle that has expiration and strike. Here's what this means. Options are either in, at, or out of the money, which means that they have a strike price that's either equal to or very close to the current spot price, above the spot price, or below the spot price. There are, like I said before, options give you options, so there are ways to adjust your risk. And what I'm going to do is there are more than, by the way, 4 option strike prices available on any given in any given month. What they've done is they've just shown me the 4 closest to the current spot price. But I'm going to increase this up in the upper right hand corner. I'm going to move this up so we can get a real good view what's really available. Let's scroll down, and the calls are over here on the left. This is the calls column. We're not going to worry about that yet. I'm going to be looking at, or I'm sorry. Let me restate. I am going to be worried about the calls. That's the one we're going to be dealing with right now. And then puts on the right hand side. So what I'm looking for is, and you'll notice that the further I go higher in the spot price, so as the strike prices rise, you'll notice that the prices, the bid and ask prices, fall for calls. Calls become worth less as you go further out of the money, meaning that, if I sold a call right now, I wouldn't really have any obligation at all, and I'll show you why. So if I were to sell the 110 calls, so remember, if you recall, I drew my resistance line up there at 110, and I felt like, well, as long as I don't know where the market's really going to go, but I doubt that it's going to get up to 110 in the near future, and it's probably going to fall in the near future. I think there's a high likelihood that that's the case, but I don't really want to short it because it's looking really whippy, if you will. So what I can do is I can sell a call at 110, which right now, when you're the seller, you kind of have to count on basically just taking the bid price, the lower price. So I would make 49 cents. Well, that's a little deceptive actually, because options are priced in quantities of 100. So what that actually means is that I would be paid $49 for that contract, and it's equivalent of about a mini contract. So one way you could look at it is that I'm being paid 49 pips worth of profit right up front. So I'm going to do this. So I'm going to go ahead and I just clicked on that bid price, and it's put up a little order entry bar up here at the top. Sell 10 contracts, so that would be the equivalent of a full lot at 49 cents. I'm going to confirm and send that out there. Now it's going to sit there until the market opens, and then we'll see whether it gets filled or not. So let's shift gears here a little bit, and let's talk about what we did. I'm going to go back to my charts. Okay, so we're looking at the dollar yen again. And in this case, let's just review that we basically thought that the market wasn't probably going to go above 110 in the near term. And so we sold a call with a strike price of 110. Here's what that means. We're obligated at this point to sell this particular currency pair for 110. Now, would anybody want us to sell this currency pair to them at 110? I mean, I'd love it if people wanted me to sell this currency pair to them for 110, since it's only worth 106.63 right now. So no, they're not going to want to execute on that contract. That contract essentially has no value to the buyer. Kind of funny that they would pay us for it. But what they're doing is they're essentially speculating the other side of this transaction. They're speculating that the market's going to go way up and eventually that option is going to become worth a lot of money. Well, what happens is between now and expiration, no one's going to want to exercise that contract or call us out, if you will, if the market continues to be worth less than what they could exercise the option for. It's something like if I wanted to buy an iPod today or an iPhone today, and I wanted to be able to, I knew there was going to be a shortage of iPhones in the future, and I wanted somebody to be willing to sell it to me anytime in the next couple of months for $500. And I wanted to buy and I paid them to just kind of be ready and available to sell it to me for that price, should prices ever rise. Well, that's kind of the same thing that they've done here, except we're the seller. So we're kind of acting as the insurance broker, if you will. So what happens is that as the spot price falls, that option will become worth less and less, because it becomes less and less likely the further it goes down. Let's say that the market got all the way down to 105.50 today. Well, that option is not going to be worth 49 cents anymore, or $49 per contract anymore. It's going to be worth a lot less than that. And at that point, we could then buy back that option and take those profits off the table. So if it falls in value from 49 cents or $49 a contract to 25 cents or $25 a contract, we could then exit the trade for a profit of $24 a contract, and then re-enter a brand new one with a lower strike price and a higher profit potential. So it's with that. Conversely, even if the market rises, as long as it stays below this 110 mark, over time it's going to continue to lose this little what they call premium, or this time value that was currently priced in there, 49 cents. It has no real intrinsic value because the market isn't even up at that price right now. So it continues to lose that the closer you get to expiration. I'll show you exactly what I mean by that. If we go back to the paper money platform, I'm going to imagine that we had done the same analysis and that prices had been consistent all the way back in December when we would have been looking at the January options. Well, I'm going to pull up the January chain sheet, which I've done, and let me just increase the number of strike prices that it's showing me. And the 110 calls are essentially worthless. They have no bid price. The ask price is 10 cents. So, but you know, back then they would have been, so it's the same strike price. It's just that there's no time left. So there's almost no likelihood that this contract is going to get, that the spot price is going to get up above 110 today, and therefore that contract isn't worth anything. Well, that's great for us as the seller, because we basically sold an asset that obligated us to fulfill on an obligation that then we have never had to fulfill. So that's the idea. That's the primary concept behind selling options, and it's why traders do it in the first place. This is why options traders do it in the first place. There's a great study, actually, I've quoted it before, where they compare option sellers to option buyers. And because you have the advantages of time premium and volatility, and you don't have to be as precise in your forecasting, etc., option sellers tend to outperform option buyers over the long run. So it's a great way to look at being in the market. Let's look at another example. I'm going to go back to the charts. And I am looking at the Aussie dollar. So we've got the Aussie dollar here, and I'm in a similar situation with the Aussie, but because while I'm long-term bullish on the Aussie, I'm still staring this little gap here just is freaking me out because we got this gap there in early November. The market came down, has come all the way back up, and then bam! Just got shoved right back down again. So while I'm actually pretty bullish on the Aussie over the long term, in the short term I think it's going to be a rocky ride, and we really haven't had a lot of movement here in to the downside or the upside. I mean, relative to the amount of time that has passed. I mean, it's been nearly 3 months. And the market really hasn't moved a whole lot. The trend has been reasonably flat right across the board here. So there are ways to, as an option seller, to take advantage of this. Now we could kind of analyze this from the same perspective that we analyzed the yen by saying, well, shoot, I don't think it's going to cross above that gap. That's a significant resistance area. So I'm just going to sell a call at the 9100 strike price, which we definitely could. I think that'd be a great strategy. Or we could sell an option at the $9,100 strike price, and if we also think that the market is unlikely to go down below the bottom of its channel here at 8,600, we could sell an option down there too. So we could basically sell an option that as long as the market doesn't go below this line or above this line, we keep 2 premiums instead of just 1. So by the way, that's called a strangle in the market. And it's something that I've talked about in these webinars before with FX Street. Which, by the way, are the one that it's neutral option strategies. If you want to check it out, it's available recorded on FX Street and of course on my own website as well at pfxglobal.com. There's another version of the same kind of idea, which is a straddle, where we basically take the current price and we sell 2 options at the current price, which pays a much bigger premium, and we have a lot wider range that the market can channel in. But I'm going to stick with the strangle right now. So we're going to take the concept we just talked about on the yen, and we're going to apply it to the Aussie here, and we're just going to say, well, I think that the market's going to stay within this range or this range. But the story gets actually a little bit better, because it's not just these ranges. This area here is not really our profit range. It's actually a little wider than that, and I'll show you what I mean. So I'm just going to jot down these prices. We're talking about the $9,100 strike price up above, which would be, we'd be selling a call at that strike price, and let's say the 8,600 to the downside. So I'll move this a little bit. Okay, so 8,600 right through the middle of these dojis. Let's go back to our paper trading platform. And by the way, if you are interested, XDA is the stock symbol that we're going to be, is the option symbol we're going to be looking at. Those are the options on the Aussie dollar. And you'll notice I've got my quotes here, but it looks a little funky. Just for convenience of pricing the options, they moved the decimal point. It's no big deal. It's just moved over 2 places. So if you took that decimal point and you pushed it back over in front of this first 8, then you'd have the spot price again. So don't worry about that. This is totally normal. Okay, so we're going to go to February, and we were looking at 2 strike prices. So we figured that it was unlikely to go above the $9,100 level, or the 9,100 level. So 91 is that strike price right there, and it is currently, we could sell that for $23 a contract. And if we go up, we were looking at the 86. So on the put side, we can sell that one for 68 cents, or $68 a contract. You add those together and you get basically 91 cents or $91. So here's how that translates into, so if we were to sell both of those 2 things, we would essentially have two obligations, but we can only be called out on one of them, of course, because the market can't go two directions at once, no matter no matter how it seems at times to do that. But we get paid two premiums, even though the market can only go one way or the other. So let's look at the chart itself and see what that actually does to us. So I'm back on the chart. Now, what just happened though is that because I got paid that premium, it essentially extends my break even out another 91 pips. So I'm actually not at 9100 to the difference between profits and loss, but I'm all the way up here at 92, and I'm all the way down here at 85 almost. So I really have a very wide channel in which the market can move as the option seller, and I really don't have to have forecasted very much. I just have to have been thinking about how dramatically could the market move, and I don't even have to wait till expiration. If the market just continues to channel over the next 2 weeks, as it has over the last month or so, well, those two option contracts are going to lose a ton of value because the tighter the time frame is, the lower the probability it is that the market will meet either one of those strike prices. Those options will fall in value, and I can then buy them back. Instead of for $91, I can buy them back for, let's say, $50 or $40 or $30, depending on how long I let it leave it alone, and I walk away with a nice little profit. That's something, by the way, I manage a trading strategy in my own account where I'm selling options every month. And if the market is moving against me, I'll buy back the options and sell a new one with a more favorable strike price, and kind of harvest that premium over and over again to try to offset the losses that I'm incurring on being wrong on the overall direction. So this concludes my presentation. I wanted to be able to walk through a couple of examples, which we did on the yen and on the Aussie. It's something I'm pretty passionate about, and I find a lot of forex traders haven't done a lot with in their trading, and yet can be such a great way to diversify your trading strategies, to increase the probability of being successful. There are ways to sell options to control risk. There's a version of the covered call, if you will, or covered option writing that I've given presentations on before. That's a great way to control risk on directional trades. So it's an awesome tool to add to your portfolio, and can help eliminate a lot of the erratic risk or the volatility risk that's inherent in the market. So I probably have 1 or 2 minutes if anybody has any questions. If I can't get to it really quick, my email address is john@pfxglobal.com. I record these presentations for FX Street, so the recording will be available for you to review on their site as well as my site. So if you want to go back through it, and if you'd like a copy of the PowerPoint presentation to review some of the concepts that I talked about, you're more than welcome to it. Just send me an email and I'll forward it right out to you. Well, thanks everybody. I think today promises to be a very exciting day in the Forex. So be safe trading, and let's see what Bernanke has to say. I think that'll probably be the big news over the coming day. So thanks everybody. Again, really enjoyed it.